everyone imagined that the passion for tulips would last forever, kind of like the passion for Tesla stock. At some point, the music will stop, and there's going to be guys that are sitting on more stock than they want to own, if they want to own it at all. And there's not, the next bid is going to be a lot lower than where they bought it, and, for their kind of size. And that's what gets it started.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and it's a new week, which means we are quite fortunate to get a new version of the Denver Dave Hour. Well, maybe not actually an hour, but good topic to run by you today, Dave. Although before we get started, folks, if you'd like to go ahead and hit that subscribe button, we'll be doing this again in the future, especially with repo lines galore and all sorts of other nonsense in the markets. That way you can stay posted. So with that said, Dave, great to have you on here as always. And how are you doing today, my friend?
I'm doing well. Great to be back as well. Thanks for hosting me.
Well, it's a pleasure to have you on here. My mom found it amusing, you giggling at me in the salt cave meditating. So we'll see if we can top that. Today, I thought it would be fun to dig into just some general mindset advice. I know you have quite a bit of experience in shorting some of these bubbles, whether it was back on the trading floor or during the .com or subprime days, and just giving people some framework, because I think there's a lot of folks out there that see the insanity. I think Tesla's over $500 a share now. So we will dig into that, although I know you had something to share before we do.
Yeah, just with respect to the fact that the markets are melting up right now, and it's definitely, this is so similar to what it was like in late 1999, early 2000. And believe me, it was a lot worse and a lot more manic then than it was in the stock market run up that culminated in 2007, or even the one, because I was actually working on Wall Street after college in 1987 when the Dow fell 22% in one day. But at any rate, this is from GATA's Chris Powell, and we were going back and forth today about the melt up in the stock market and the melt up in COMEX gold contract open interest, which it's popped up back up again, and it could go over 800,000 today. But this was his quote, because I happened to say that I said I believe there's a strong correlation between the melt up in the stock market and the melt up in precious metals derivatives, especially COMEX contracts. And he quoted from an article that he wrote that people listening to this, it's a must read. To be honest, I think it's probably the best thing. And I told him this. I said, I think this article is one of the best articles on the subject matter, i.e. bubbles and money printing, that's available. And the quote is, "The infinite monies lately being created and distributed by the Federal Reserve Bank of New York means infinite leverage in the markets, infinite market rigging, infinite speculation, infinite misallocation of capital, and infinite corruption. But to succeed, it requires infinite commodity price suppression, or else government currencies are ruined." And he's basically referring to gold and silver. So the article, you can get the article at gata.org, and the title of it is "The Signs Swirl All Around Us, So Is the Reset at Hand?" And it was published on December 24th.
And we will put the link to that below so folks can go right in the description to find that too.
So at any rate, I guess you wanted kind of my thoughts on, I don't know, establishing short positions during a market melt up.
I mean, I guess you could say that, or perhaps phrased a little differently, given what you just read from Chris. I think a lot of the folks watching this, it's not coming as a complete surprise. We've talked about it before, yet maybe something I've wondered is, are there any signs, or when do you, how do you know when to establish a short? I mean, Tesla or some of these stocks that you can dig into the fundamentals and it often paints a clear picture, yet especially now where we're not, I mean, I used to think, well, when rates go up, then that's when the thing pops. But what if we're probably never going to see rates go up again? And any general thoughts on how to approach shorting something like that?
Well, I mean, that's the problem. I mean, in my last short sellers journal, I referenced the Dutch tulip bulb mania. And it's interesting because, and I posted it on Twitter yesterday, there's charts of the price rise in Dutch tulip bulbs, and it was one specific type that was bid up the highest. And if you look at the chart of that, the chart pattern is identical to the chart pattern in Tesla. And if you want, I can email you that graph.
Sure.
And you can put it up here. Charles Mackay, he wrote a book that was basically about Dutch tulip bulb mania, or that was the premise for the basis of it. Extraordinary popular delusions and the madness of the crowds. And I've read sections of it. It's a freaking long book. But he talks about in there the psychology of that kind of engulfs the markets and the participants in the market when you have a situation like this. And it describes what was going on in late 99 exactly. And it describes what's going on now. Here we go. He said, he's talking about many individuals suddenly grew rich. And this is in reference to the buying and selling of Dutch tulip bulbs as the price rose. And the price that someone was willing to pay for a Dutch tulip bulb, I mean, it rose well beyond any kind of possible useful or intrinsic value for Dutch tulip bulbs. And he said, a golden bait hung temptingly out before the people, and one after the other, they rushed into the bulb marts like the flies around a honey pot. Everyone imagined that the passion for tulips would last forever, kind of like the passion for Tesla stock. And that the very wealthy from every part of the world would send to Holland and pay whatever prices were asked for them. And then he talked about how suddenly in February 1637, he's talking about how the scheme can't last until someone was ultimately willing to pay, keep paying higher and higher prices to keep it going. I mean, you can call that a Ponzi scheme or a bubble, whatever. And suddenly, with no explanation, tulip traders could no longer find new buyers willing to pay increasingly inflated prices for the bulbs. And as this realization set in, the demand for tulip bulbs collapsed. And I mean, we saw that with a number of stocks, dozens of stocks during the dot-com bubble. It was the same thing. People had this idea that, all you had to do was have a website and you all of a sudden created wealth. And that became kind of the zeitgeist, I guess, if you want to say. And so there were dot-coms going public that didn't have any revenues, losing money, burning cash. There were plenty of dot-coms that had revenues. I mean, Commerce One went from $10 to $600 very quickly. In fact, I was caught short that at 300. I mean, I ultimately held on to it, and within 3 years after the bubble burst, Commerce One was out of business. Stock was worthless. But people didn't care. I mean, they fell prey to this idea of clicks and eyeballs. That was what the mantra was on CNBC. And all the genius stock analysts that came on to CNBC, hey, it's a new economy. It's clicks and eyeballs. They never explained how it was going to generate revenues. It's just like with Tesla. I mean, if you apply proper accounting to it, it loses money on every single car it sells. The source of cash earnings from Tesla comes from selling environmental EV credit, or they're ZEV credits, what they're called. They're basically regulated environmental credits that car manufacturers have to generate. And if you don't produce EVs, Tesla will sell you the EV so that you're in compliance, or the credit so that you're in compliance with the regulations. Well, they generated, and I forget the numbers off the top of my head, but it was of their gap reported income. That was most of the gap reported income, and that's a non-sustainable business model, because starting this year, all of a sudden, legacy OEMs are going to be producing and selling a lot of EVs. Porsche sold out of its Taycan pre-order allocation. The Ford Mach-E, the pre-orders there are sold out. And I mean, just in China alone, there's going to be 67 different types of EV models that are produced or that are rolled out this year. So at some point, there won't be any demand to purchase these credits. So that's gonna essentially, that part of Tesla's business model will go away, and it won't be generating any cash earnings. So and then they do all these accounting schemes to manipulate their income, the way they account for warranties, or for overhead depreciation. There's all kinds of things going on in there. But if you back all that out, they don't generate any cash from vehicle sales. And what people are pointing to as, oh, well, they had free cash flow in the third quarter. Well, no, they didn't. A large portion of that free cash flow cash flow generated from operations came from an increase in their accounts payable, right? Accounts payable are a source of cash for a business. So at any rate, what happens is people become impassioned irrationally about these ideas, and they're willing to pay more and more, and it becomes a self-fulfilling feedback mechanism where the price keeps going higher and higher until at some point it just stops. And when the music stops, everyone looks for a chair to sit down in. And just like every other bubble before us, there's not going to be enough chairs for everyone who is long Tesla stock, or whatever stock it is that's being bid up right now, Beyond Meat, for example. There won't be enough chairs for people to sit in, and the bid will dry up, it'll disappear, and prices will plummet. And this is a dynamic that I saw in the junk bond market, because the junk bond market, especially in the 90s, was a lot of the junk bond issues were not liquid. And a lot of times issues would go, especially ones that had high coupons on highly risky companies, they'd be small issues, and there'd be a few controlling holders of it, and there would not ever be bonds for sale, so there were only bids. But then when something hiccuped at the company, and all of a sudden the credit started melting down, not only would there not be any bids, then you would only have offerings in the bonds. And so it falls in a step function. And when these bubbles peak, and again, there's no way to know when it's going to happen. If anyone says they can call the top of this, they're insane, or they're lying. But at the top, when it starts to go down, it goes down in step functions. I saw that in 1987. I mean, if you were around then and watching the Dow, it literally would fall straight down, and they would have circuit breakers, and they'd close the market for a brief period of time and then reopen it, and boom, it would go down again. And we've seen other instances since then where that's happened.
Yep.
So at any rate, if you want to, the way I'm doing it with Tesla is every day I take a stab at puts, and if like the stock keeps moving higher, I sell the puts. I'm not afraid to take a loss. You can't be afraid to take a loss in these situations. But if you want to catch it when it's going down, you have to be involved, because by the time it starts falling again, you'll say to yourself, okay, I'll wait for it to bounce tomorrow, and then I'll short the stock, or I'll buy puts. And you'll wake up in the morning and it'll be down another $20, and you'll say, okay, I'm not going to chase this. I'll wait for a bounce. You might not get a meaningful bounce in something like Tesla for $100, So, and again, I'm not saying that's how it's going to play out, but that's an example of how it works. That's the problem. I hear people say, oh, well, I'll wait until the market tops and then I'll jump in it. Well, I remember in October of 2018, I had some decent short positions on, And I said to myself, okay, before I put any more on, I want to see this thing roll over. And then all of a sudden it started going down, and it almost went straight down for a couple weeks. And at that point in time, I was like, God, I don't have enough short positions to really take advantage of this. So that's my point about, when you decide to start, when you decide to say, okay, this has gotten beyond the point of silly, I'm going to start shorting it. Don't be afraid to take a loss if it goes against you, but you got to stay involved in it at all times, or you're going to miss it. So one of the things I'm doing, and I can't remember, I normally would save ideas like this for short seller journal subscribers, but I started accumulating at the end of last week, the Tesla January 2021 200 puts. Now, am I going to make money on those or not? I don't know, but it's far enough out that if I catch a good downdraft in the stock, I'm pretty confident I'll be able to sell those puts for a much higher price than what I paid for them. I don't have to hold them until they expire, right? If you get a $50 or $100 downdraft in a short period of time in Tesla stock, I mean, those puts will probably double. So that's how I'm always kind of keeping an iron in the fire without burning too much capital towards it, in case it goes higher. And actually, these puts, I mean, the stock's probably up another $40 since I started buying them. And they haven't really gone down in value that much because they're so far out and they're far enough out of the money that their responsiveness to upside moves in the stock doesn't take away a lot of the time premium. I mean, we could go into the mathematical explanation for that, but I don't want to put people asleep.
Yeah, well, you have a lot of good points that you raised in there, especially going back to October, the end of 2018. I think maybe that's the variable. Maybe this was always at play and I was just naive, but then we had that plunge protection team meeting. I think it was on Christmas where all of a sudden the market started rallying. Now we have a Federal Reserve that, is taking rates back down to zero, doing something they don't like to call QE, which introduces that variable that, you mentioned how when the pool of buyers gets exhausted, that's typically a sign, and you've written a lot about that in the mortgage market in particular in your short sellers journal. Maybe with all the money that the Fed's pumping in, which my guess is probably just the beginning, and no matter what happens, they'll keep pumping more in. Maybe is it a way to think about it is that you want to be maybe lessen the aggressiveness while they're doing that until we have something like 2007 or 2008 when you actually see a bank fail and then you hop in. Any framework for just balancing the fact that on one hand the pool of buyers to keep propping it up is getting lower, yet the Fed is creating more of them as it gets lower?
Well, again, you bring up a good point with the example of the banks failing because, again, I'm just pulling up a chart here so I get my dates somewhat accurate. But, again, there's not any one sign on all of a sudden why, the crowd psychology decides to go from one side of the boat to the other. I mean, right now, everyone's on the buy everything until you drop side of the boat.
Yep.
Including hedge funds, including professional investors. I talked to a guy yesterday who said that he spoke to the head trader at a prime brokerage firm, and the guy told him, he goes, look, you got, small size hedge funds are buying and flipping 5,000, 10,000, 15,000 share lots of Tesla, and they're buying it and 10 minutes later selling it. I mean, they're not investing in Tesla. They're just trading the momentum. And he said they're going to keep doing it until it doesn't work. And that's what I'm talking about. At some point, the music will stop, and there's going to be guys that are sitting on more stock than they want to own, if they want to own it at all. And there's not, the next bid is going to be a lot lower than where they bought it. and for their kind of size, and that's what gets it started. And they're not going to care if they lose money on that trade because they've made money trading it on the way up. But you mentioned the idea of, oh well, I'll wait until I see a bank fail or something. And I don't know that a bank failure is not going to trigger it this time, because the Fed's not going to let banks fail. It's already, let's cut to the chase here. This repo operation is not putting temporary liquidity into the overnight interbank lending market. This is a de facto bank bailout, because the banks are a lot of their assets are starting to melt down. And then today, the Wall Street Journal reported that the Fed's contemplating directly giving repo money to hedge funds, right? So, and that's a bailout of the hedge funds, because the hedge funds and the banks are all sitting on the same types of assets that are melting down. Leveraged loans, the lower half of CLO tranches, OTC derivatives, credit default swaps, and things like that. And those assets are starting to go bad. Subprime consumer loans, whether it's auto loans, personal loans, or credit card loans. I mean, hedge funds have pools of capital where they're underwriting, or they're funding subprime jumbo mortgages, right? Because they're getting a higher rate on that. So, and hedge funds are levered up. So when their assets start to go bad, it really goes bad for them. And that's part of the problem with what's going on with the repo market. Is banks don't want to lend overnight to hedge funds because they don't want their overnight collateral. I wrote about it today on my blog. But at any rate, if you look at the financial crisis in 2008, which was a de facto financial system collapse, the stock market started heading south in October 2007, all right? It peaked then and started heading south. You didn't have Bear Stearns go tits up until, I believe, late March, I think it was early April in 2008. So if you were waiting for a bank to go bankrupt, you missed a 300, well, more than that. You missed about, so the S&P, when Bear Stearns went under, the S&P had already dropped about close to 200 points.
Yep.
Right? So 2,000 Dow points, give or take. And then the market bounced after Bear filed. And then it went down again. And I don't remember the exact date when Lehman collapsed.
I think Lehman was September 15th.
I forget, you can look it up. But the stock market started heading south again in May 2008. So, if you were waiting for a bank to collapse and you didn't short the market after Bear collapsed, what were you waiting for? Because after that, after mid-May of 2008, the S&P fell almost another 800 points from that point until, I think it was late March where it bottomed. Early March, where it bottomed at 666. Wow. So that's my point here, is you kind of, you see this thing going up. You don't know where it's going to top. No one knows. And you just got to kind of wade in slowly. And if you're waiting for a bell to be rung, you're going to miss it.
Yeah, and you also mentioned in there a little bit earlier about the idea of using puts rather than shorting the stock outright. Again, I'm a former equity options trader, so that has appealed to me a lot, where you can limit your downside. You can take some educated, try and pick your spots, and perhaps we can dig into that in a future week a little bit more, as I know you have a few things to take care of today, but appreciate you sharing some general framework. Not that there's an exact answer to these things, although something I've been
there's no science to shorting a bubble. I mean, you just got to lick your finger and stick it in the breeze and not be afraid to take a loss if the market goes against you. You want to save your capital and just stay involved, because you do want to be short when the market does start to head south.
Right. And along those lines, like you said, being able to take a loss, accept that, move on, Also, perhaps not expecting to catch 100% of the move, because maybe that's not really realistic. But if you capture 50% of a move, especially in these situations where there's been so much energy to one side, you're likely to have a big move whenever it does happen. And like you point out, if you can stay in the game and be able to capture even part of that, have a good chance to come out ahead. So, Dave, appreciate you joining me as always. Hope this is really helpful for folks. Again, not that it's going to be easy, but you provided some framework, and I am grateful for that. And real quick before we wrap up, just again, let folks know where to find you in the journals.
investmentresearchdynamics.com, and there's links for more information to both of my newsletters, the Mining Stock Journal and the Short Sellers Journal.
All right, my friend. We will have those posted below as always, and look forward to catching up with you next week.
Likewise, Chris.